Hello there. Welcome back to Grade Core of Accounting. In this video, we want to look at a question for cash flow statements and financial indicators. And we see that our question has got 40 marks. It requires you to spend on average 30 minutes on this question. This is a question that we have on non-Guinea Limited, whereby we are given the information related to the financial year ended 29th February 2024 on the required part, that is 2.1, reads complete the following note to the cash flow statement, that is the reconciliation between net profit before tax and cash generated from operations. Then our 2.2, calculate the following amounts that would appear on the cash flow statement. We've got our 2.2.1. You have to calculate the income tax paid with 4 marks, and then dividends paid with 4 marks, and then the purchase of fixed assets with 5 marks. So this is the question that we have. Then we try to go down with the question. You see that on 2.2.4, it requires you to calculate net change in cash and cash equivalents, and then 2.3, calculate the following financial indicators for the financial year ended 29th February 2024, whereby you're given the current ratio, percentage return on average capital employed, and dividends per share. So these are the questions that we have. So given the information now, you're given information A, whereby you're given extract from statement of comprehensive income for the year ended 29th February 2024. So this is the information in terms of statement of comprehensive income on information A. So you can go and try to see on the next page what we have. So if you come to the next page, you'll see that we're given information B, where we're given extract from the statement of financial position at the end of February, whereby we are having 2 columns for 2023 and 2024. So our recent year, which is our current year, becomes our 2024. Then you go now and see other information. We've got other information that are continuing there up to information F. And then we can see that this is all the information that we have according to the question. So you can try to go and see the first question that we have, which is saying complete the following notes to the cash flow statements. That is the reconciliation between net profits before tax and cash generated from operations. So we go to our answer section and try to see what spaces are we given according to the answer book. So if you come here, you'll see that this is the cash reconciliation between net profit before tax and cash generated from operations. We are given some figures being pre-entered there from net profit before tax down to operating profit before changes in working capital. So we are supposed to calculate the cash effects of changes in working capital. So remember, only effects of changes in working capital, remember when you're calculating working capital, when calculating working capital, we use the formula that working capital is equals to current assets minus current liabilities. So basically, the components of current assets and also the elements of current liabilities. So elements of current assets and elements of current liabilities are the ones that are going to look for to affect the changes in working capital. So basically, that's what it means. So we are going to look for those elements. So here, we know that when it's an increase for assets, for current assets, when you're having an increase, we have to subtract under this statement. And then when it's a decrease, it becomes the opposite, we add. Then for current liabilities, when it's a decrease, we subtract. It becomes the opposite. When it's an increase, we add. So this is the scenario that we have in terms of changes in working capital. So we're going to go there and try to see what do we have in terms of those elements. So we go to the list of balances that we are given. Let's see what do we have. And if you come here, you start with our current assets. Our current assets are here. So you can start by inventory and see that it's a movement that we are having from 2023 to 2024, whereby it was 672,500 to 710,500. So we are seeing that there is an increase that is there of inventory. So we just want to calculate the increase that we have there, whereby we are saying 710,500 minus 672,500. And obviously, an increase you are supposed to subtract. So it is a negative figure. So we go to the other section. And we are now here on if cash effects of change in working capital. So it means here now we are saying increase in inventory, increase increase in inventory. Then on the other section, we are supposed to show the working whereby we are saying 710,500, and then we subtract our 672,500. So you calculate correctly this calculation, you are going to get see that you are going to get 30,000 as the increase. And we said we are supposed to show it as a negative, so you can just put it in brackets. Then we go and check again. Coming to our current assets, you see that the next one is trade and other receivables. We are here. So we are seeing that again it's a movement of 256,830 to 290,115. So we are not seeing an increase again, whereby we are seeing now 290,115 minus 256,830. Then the increase again, we show it as a negative. So here you are going to say increase in trades and other receivables. So in brackets, we can just show at the wiki, whereby you're saying 290,115, and then we subtract 156,830. So these are the calculations that we have. And then we subtract correctly there, we're going to get a difference of 33,285, which is an increase, and an increase to show it as a negative. So put the brackets again, and we'll try to see again. So we come here again, we try to see what we have. Then coming here, we know that we have got cash and cash equivalents, of which cash and cash equivalents is the effects that we are showing in the cash flow statement. So we're not going to look at the increase or decrease in cash and cash equivalents. We'll deal about it when you are now in the cash flow statement. Remember, this is a note to the cash flow statement that we are preparing. So you're now in the cash flow statement, we are now going to look at the movements of cash and cash equivalent. So this one I'm not going to include it in this note. We go to under share, we go to our current liabilities. Remember we said working capital. We've got current assets minus current liabilities. So we are looking at the elements of current assets and current liabilities. So we are here. So we check on trade and other payables. We are by movement from 466,620 to 429,660. So we are seeing that there is a decrease that is there. So we are just going to show the decrease that we have there, and then calculate the decrease, which is going to be 466,620 minus 429,660. So we go there. And so know that the other payables is under current liability. So when it's a decrease, it's we're going to show it as a negative again. We are seeing here. So we can just show here by saying decrease in trades and other payables. And on the working part now, we say 466,620. We subtract 429,660. And then we are seeing a decrease of 36,960. Right, we do that. If we are going to get our final figure that we are supposed to get is cash flow from operations. So basically, on our calculation part, we are going to add all the changes in working capital, whereby we are saying negative 38,000. We subtract negative. We subtract 33,285. Subtract um 36,960, and then a year also we're going to get a negative 108,245. So obviously, this one is in brackets. So we now say operating profit before changes in working capital, and then minus cash effects of changes in working capital, which is 108,245, and we are going to get 1 million. The final answer that we are supposed to get there is going to be 1,129,515. So this is the final answer that we are getting there. Then this figure becomes our cash generated from operations, and then we have finished the notes that we are preparing, that is the reconciliation between net profit before tax and cash generated from operations. So from there now we go to 2.2. So on 2.2, it reads calculate the following amounts that would appear on the cash flow statement. You are given income tax paid. You are given income tax paid. So to calculate income tax paid, we are going to look at the SARS income tax amount that we are given in the list of balances. And then the amount that we are going to we are going to say opening balance of that SARS income tax. If it's having an opening balance of on the credit side, and then we have also the closing balance, that is our balance CD on the debit side. So we are just going to say opening balance, or we are saying if the opening and closing balance are liabilities, are other current liabilities, we are just going to use this formula where we are saying opening balance. We add the tax for the period that is charged in the income statement will also be added here, the tax amount, and then we are also supposed to subtract the closing balance of that taxation amount that we're having in the list of balances. So basically what we are saying, we come here on the list of balances, and we are saying the tax amount that we are having is in the beginning. Remember, the beginning is this one, is 25,870. This is our earlier year, which is 2023, then we have 2024. So the beginning balance will be on 2023, which is for tax we have got 25,870. Then we add the tax amount for the period which we get in the which we are supposed to get in the extract that we are given from the income statement. So you can come here and try to see the figure for tax. We are given income tax here, which is 245,560. So this is the figure that we are supposed to add to the opening balance, which is 245,560. Then we subtract the closing balance. The closing balance, we come here again, you see that the closing balance is this one, which is 10,530. This is the amount that you are supposed to subtract. So you can just go there and summarize that working. Whereby you are saying opening balance 110. Sorry, at opening balance we've got 25,870. 25,870. We add our tax for the period, which is 245,560. Then we subtract the closing balance of tax, which is 10,530. And then we are supposed to get 26. We are supposed to get your 260,000 900. So this is our final figure that we are getting for our text. So let's just try to see. So here we are saying 260,900. So this is the figure that we have. And then remember our taxation can have a a current liability opening balance or a current asset opening balance. So if we are having such a scenario whereby it's having current assets, we can just try to present it in a tier account so that it becomes easier for you. So what we are trying to say is the balance that we are having here for SARS income tax that we are having here is opening balance. This might be a current asset or might be a current liability, depending on the question. So we are saying for SARS income tax, if you try to present it in the form of a T account, we are going to say that if the opening balance is on the credit side, it will be um, a current liability. If the opening balance is on the debit side, it will be a current asset. So this is kind of that way. Then the closing balance, obviously, of a current liability will come on the debit side, and then the closing balance of a current asset will come on the credit side. Then the amount that is going to the profit and loss to the income statement or the profit and loss for the tax for the period will come here on the credit side. Then the amount that we need in the cash flow statements is the one that will be paying here and will come here. So this is the amount that we'll be looking for. So in the event that we have got an opening balance on the debit side as a current asset, and then we have a closing balance there. So we are just going to make a calculation as such. So you put your figure here, which means maybe we have got 100 here, we have got 50 here, and here we have got maybe 150. So it means that to get your bank, we are supposed to say to get your the amount for bank, we are going to say your profit and loss figure 150 plus your closing figure the minus the opening to get this one. So you can just calculate it as depending on the figures that you are given. So this is what we have according to taxation. So it might let's go and try to see according to the next question that we have in the on the beginning of the question there to try to see what the next question that we are going to look at. So we move on to the second part of the question, which is a dividend paid, calculation of dividend paid. So remember, on dividend paid, we are going to say, let's just try to bring down the formula based on calculating dividends paid. So dividends paid, we are going to say the opening balance. We add dividends, total dividends for the year, or total dividends that are supposed to be paid for the year. The other way, we're saying interim plus final dividends, and then we subtract the closing balance. As simple as that. So we go to the question to try to see in terms of those elements. Obviously, the opening and closing, we get them in the list of balances here, whereby you say go to shareholders for dividends information, whereby they say if opening balance is 210,000, we add total dividends for the year. Try to look if you were given the figure for total dividends in additional information. And we try to go there and see if we have got that figure for total dividends. We see that we are not having that figure. We can just try to come here and see if we have got it. But we are told that if you come here, where they are saying dividends, we are told that the interim dividends, interim dividend of 80 cents per share was paid. So the interim dividends is the one that we are going to calculate. So to get the total dividends, you can just maybe try to bring down the formula again, total dividends. we're going to say the opening balance of dividends plus the interim dividends. So remember, the opening balance will be the balance that is coming from the previous year as an accrual. Obviously, this one is going to be paid at the beginning of the year, then plus the interim dividends which are paid, which are also paid during the year. So our opening balance is the one that we are given here as shareholders for dividends, which is 210,000. So we are going to say 210,000. Here we've got 210,000, so we've got to go to 210,000 representing our opening. Then plus interim, we are told that it's 80 cents per share, but it was paid on 1 September 2023. And 1 September, we know that at the beginning of the year, we had 140,000 shares a year. And then on 30 April, which is before 1 September, there were additional shares that were issued of 300,000. So basically, we are saying 140,000 plus the additional shares of 30,000. This is 140,000, and then with the additional of 30,000 uh, before we reach 1 September, and then we get 170,000. We get 170,000. Then having that now, we can now be able to uh, to to use the 170,000 to get the interim dividend, whereby we are saying the 170,000 we multiply by 0.8. So we can just try to calculate there, whereby saying 170,000 times 0.8 is our 80 cents. And we are going to get your 136,000. So if you say this 170,000 shares times the value per share, which is 80 cents is a decimal is 0.8, you are going to get 136,000. So this is going to be your interim. So you add on your interim here, it's 136,000. Then the total figure that you are supposed to get there, you are going to get 346. So this is the working that we are just going to summarize. So 346,000 becomes the total dividend. So we can just go there and summarize that working, indicate our total dividend. So here we are saying opening balance of dividends. The figure that we have is 210,000. 210,000. And then we add total dividends, and then we add our dividends, our interim dividends, which you got is 206,000. And then the total amount that we're supposed to get there is 346,000. So you can use this way. This is another way that you can get the answer, or you can just say opening balance plus interim. This is the second method that we used. You get the same answer. We get 346,000. If you use this method, or use this one, saying open balance plus interim, but depending on the information that you are given, you can use any method that is simple according to the question that you are answering. So in this case, saying opening balance plus interim was the simplest way of getting to the answer, that is 34,000, 346,000. Here we've got 346,000 is our answer. So this is what we have in terms of calculation of dividend paid. So we can try to see to go to the next question. So on the next question, we can try to see what we have. Next question is saying purchase of fixed assets. And we know that on purchase of fixed assets, we are going to say the formula that we are going to use for purchase of fixed assets is either you can open a T account, you can open a T account of a non-current asset account. And then we are saying opening balance of non-current assets at carrying value. net carrying value on the debt side, and then closing balance, net carrying value again at the credit side, and then depreciation for the year will come on the credit side, and then disposal, if it's there, you put it on the credit side at carrying value. And then you can now be able to find the purchase here as a balancing figure. So the purchase will be here, purchase amount of any additions. So it's purchase or addition. We get it as a balancing figure there. So in other words, putting down as a formula, we are saying the closing balance plus depreciation for the year. This is depreciation for the year plus disposal at carrying value. Then you subtract the closing balance. Then you get the figure for addition. So this is exactly what we are going to do. So I will go and check in terms of our closing balance. And we're given the balances are for non-current assets. Remember, fixed assets represents non-current assets. So we are saying opening balance, we've got one a closing balance, sorry, is 1,987,625 plus depreciation for the year. Depreciation for the year, we get it here, which is our 240,640 plus disposal at carrying value. If it's there, go to Excel formation to look for disposal at carrying value. We come to 6, they are saying a vehicle was sold at carrying value during the year of 110,500. So we add again disposal at carrying value, which is 110,500. And then we less our opening balance now. Our opening balance is 1,850,000. 1,850,000. 200. So this is the calculation that we are just going to summarize there on our answer section and put the answer as our correct answer. So we come here, we are saying on the calculation of purchase of fixed assets, we are saying the formula that we are employing, we are saying opening, we are saying closing balance, sorry, closing. We add depreciation for the year, depreciation. We also add disposal and carrying value, and then we subtract the opening balance. As simple as that. So we are going to say, according to the figures that we have in the question, we're going to say, obviously, the closing balance is 1,987,625. We add depreciation for the year, 240,640. We add again disposal at carrying value, 110,500. Then we subtract closing our opening balance, sorry, which is 1,850,200. And then the answer that we are getting there is 488,565. So this is what we have in terms of calculating of purchase of fixed assets. Then we can as well try to go to the next question, which is say net change in cash and cash equivalents. And we know that to get net change in cash and cash equivalents, we are going to say you need to get the closing balance. Remember, closing balance, we say get the closing balance, we say our opening balance, net change in cash and cash equivalents. Opening balance plus net change in cash and cash equivalents, you get your closing balance. So the figure that we are looking for is this one. So we can just make it the same formula. It becomes a net change in cash and cash equivalents is equals to our closing balance. We check opening balance on the other side, it becomes negative. So we say minus opening balance. So this is exactly how we are going to calculate it. So we're going to check in terms of the closing balance. So cash and cash equivalents, we see that is here. Our closing balance, we're having it here is our 85. Our closing balance is 85,150. It's 85,150. So we are going to say our 85,150 I'm trying to see the one that we are going to put here. So we say 85,150. Remember, we're saying closing balance minus opening balance, isn't it? So we are going to say 85,150, and then we subtract opening balance. Of which opening balance we've got with 5,160 here, but we also have here a bank overdraft that is appearing here of 280,400, which is a negative. So in brackets, we are saying 5,160 minus the negative balance. When it's a bank overdraft, we present it as a negative balance, which is 118,400. So we present it like that. We're going to say that we are going to leave it as 85,150. And you say 5,160, subtract 118,400. You are going to get your negative 113. So you are saying minus negative 113,240. And obviously a negative and a negative will make a positive. So it's going to leave us 85,150 plus 113,240. So we can just go and summarize this final working that we are having here. And we do add there. We are going to see that you are going to get your the final answer. You're going to get your 198,390. 198,390. So this is how we are going to summarize it on the other section. So you can just go there. So basically this in this case our opening balance is a negative. So it's going to leave as cash closing balance plus opening balance. So according to the calculations that we have made there, we are going to see 118,400. This is our, well, okay, we can just try to present it in a different way, whereby we are saying 85,000, 85,150, and then we subtract, and then the figure that we are subtracting is 5,160 minus 118,400. And then the final answer that we got there was 198,390. So this is going to be your final answer. So this is exactly how we're going to calculate it. Then you go to 2.3, which is calculate the following financial indicators for the year ended 29 February 2024, whereby we are given the current ratio, whereby you are given the current ratio. So obviously we need to take down the formula first of calculating current ratio. Remember, when we're calculating current ratio, we are going to say current assets as to current liabilities, whereby we are going to divide by current liabilities both sides. So this is how we are going to calculate our current ratio. So we just go and check in terms of the figures that we have for current assets and current assets and current liabilities. So the figures that we're going to use are the figures for the current year for 2024. So we are having current assets here is 1,085,765, And then current liabilities we're having is 728,190. So we are just going to use those figures to calculate the current ratio. So we come here. So our current assets, we are saying we are having 1,085,765 as to our current liabilities 728,190. So basically, we are going to divide by the figure for current liabilities both sides, whereby saying 728,190. Do the same thing here, 728,190. And then our answer is going to remain is at one decimal place, 1.5 is to 1. So exactly, this is how we are going to calculate this one. Then obviously we go to the next question and try to see what we have. So on the next question, we are calculating percentage return on average capital employed. So basically, we are saying the formula, we are saying net profit before interest and tax over average capital employed. So we are going to find the net profit before interest and tax from the information that we are given there. We know that net profit after income tax is 631. So to get before income tax, we add 245,560. And then to get before interest expense, we add again 120,120. So that's how we are going to calculate. So we are going to say 631,440 plus 245,560 plus 120,120 to get the net profit before interest and tax, which is going to be 997,120. So this is going to be our numerator. Then for denominator, we are going to find the average capital employed. And you know that get capital employed is goes to our equity. We're going to say owner's equity plus our liabilities, plus our non-current liabilities. We can just specify there, plus our non-current liabilities. So we are going to say for our opening capital employed, remember, now to get the average, we are going to say opening capital employed plus closing capital employed divided by 2. That's how we're going to get. So first of all, you have to find the opening capital employed and then find the closing capital employed. Then you add them and then you get divided by 2 to get the average. So we are saying for the opening capital employed, we are going to say our orders equity, which is 1,850,800 plus non-current liabilities, which is our loan mortgage loan is non-current liability, which is 510,000. So basically, we are saying orders equity we have got for opening we have got 1,850,000. 800, and then we add the figure for loan that is 510,000. 510,000, and I'll see what figure do we get to get our opening equity there, and try to see what figure do we get there. 1,850,800, and then we add 510,000. And we're going to get 2,360,800. So here's 2,360,800. And then for our closing equity, we are going to say our opening equity is here for 2,090,200. And then we add our and then we are saying owner's equity, the owner's equity is 2,090,200, and then we add the non-current liability, which is our loan, which is here 435,000. You can just maybe confirm the description. which is our non-current liabilities being represented by this loan, which is 435,000. So we get 435,000, and then we can try to calculate it there by saying 2,090,200, and then we add 435,000. And then we are going to get your 2,525,200. So here we've got 2,525,200. So for average owner's equity, now we are saying this one plus this one divided by 2. So this is going to be your denominator. You add these two, this one and then divide by 2 to get the average. And then for our numerator, remember we've already calculated here as our net profit before interest and tax. So this figure is our net profit before interest and tax. 997,120. So we go there and just substitute in our formula. So we are here, we are saying equal to net profit before interest and tax, we got 997,120. Then for opening plus opening for capital employed plus closing capital employed, opening we got 2,360,200, and then we add the closing, which is 2,525,200. And then the total that we get there, we divide by 2, so we're saying half. And then we are going to get the amount that we are going to get there. You divide, sorry, you multiply by 100 over 1. So obviously we are going to multiply by 100 over 1 so that we leave it in a percentage form. Or we can just say, after calculating, you are going to get let's just maybe try to make it very clear. When you calculate it like this, the answer that you're supposed to get will be 0.408. And then you multiply it by 100% to get to leave it in a percentage, it becomes 40.8. So 40.8 becomes our answer, which we are supposed to put in the other section. So we are saying 40.8% becomes the answer. So this is what we have in terms of our ratio that we've just calculated. And then we go to the next one, which is dividend per share. Dividend per share. So for dividend per share, we are going to say total dividends. We've got two ways that we can we can use to get dividend per share. We can say total dividends divided by the we are going to say, let's say dividends per share. We can just use the simplest way to get to dividend per share by saying interim dividends per share as final dividends per share. As simple as that. So for our interim, we are given it in the question. We're just going to take the figure as it is. Remember, for interim, they said interim dividends of 80 cents per share. So this is dividend per share, 80 cents. So for interim, we can just enter our 80 cents. So we are saying interim is equal to 80 cents. It's 80 cents. And then we enter our final. Our final now, that is the one that we are supposed to calculate according to the information given. We are saying final. It was declared at the end of the period. So we are saying total dividends that we have at the end of the period, we can just try to find out. We got 140,000 at the beginning. And then we got an additional 30,000 that was introduced, that was issued. And then we've got a repurchase of 10,000, of which repurchase we subtract. And then we get a net of 160,000 at the end. And then we divide it into the value of the shares that we have at the end. Shareholders, we are having ordinary share capital, which is 1,600,000. So we divide the 1,600,000. So we say 1,600,000. We divide by 108 what? One hundred and sixty. So remember we got 160,000. And you can just cross check our value of our owner share in the end. Yes, it's 1,600,000. So we try to divide there, whereby we are saying 1,600,000 divided by 160,000. Let's try to see if we have used the correct figures there. Remember, the formula that we are using here is wrong. So remember, to get the final dividend per share, we are going to say final dividends, final dividends, final dividends, and then we divide by the number of shares. And then in this case, the final dividends, you get them in the list of balances. We've got final dividends here being 288,000. So we've got 288,000 representing our final dividend. So we are going to say 288,000. We divide by the number of shares that we are having at the end of the year that we've just calculated there. And we got 160,000. We said 140,000 at the beginning plus 10 additional minus 10 that were repurchased to get 160,000. So those are the shares that we have at the end. So divide by 160,000. And then the final answer that we are supposed to get there, uh, the final answer that we are supposed to get there is going to be, obviously, after you have add the answer that you have get, you are supposed to multiply by 100 cents over 1, so that you leave your answer in cents, and then it becomes 180 cents. So we are going to add 180 cents as our final dividends per share. So we come here. Uh, so here we're seeing 180 cents. And then the final answer that we are supposed to get is 260 cents. So this is the answer that we are supposed to put on our answer section, which is our 260 cents. So here our answer here is presented becomes 260 cents. So this is what we have, guys, according to this video. Thank you for listening. Close with and subscribe. Please subscribe and share. We are still coming with more videos as we prepare for exams. As for this video, I'm signing out. We'll meet again in the next video.